Hello, hello. So we have some news from Twitter, which just reported earnings, and it's actually down just a little bit, 2% on earnings that were unexpected for the most part. We can take a little bit of a closer look at the stock news here. You can kind of see what is going on with Twitter right now in the markets. You will see that Twitter misses earnings expectations and blames revenue drop, partially at least, on Elon Musk takeover bid. And you could kind of expect that, but it kind of falls in weakening digital ad market is what you see as well here. And we can take a little bit of a closer look at what exactly happened with the numbers here. So Twitter reported a surprising decline in revenue as the social media company prepares to battle Elon Musk about the 44 billion takeover deal, which Elon Musk actually cancelled. Now the revenue fell to 1.18 billion from 1.19 billion a year ago, so it's a little bit less, and below the average analyst estimate of 1.32 billion. This is significantly lower than the expected revenue, as you can understand. And I'm actually a little bit surprised that the stock is down just 2%. I guess the stock has been kind of destroyed lately, and so maybe that does play a role. If we take a look at our metrics tab here, you will see the actual amount of the decline for Twitter, which has been about 50%. And so, yeah, we're gonna probably be getting a 2 to 3% decline, I suppose, today. Maybe a little bit more as the news, get transmitted to every investor, really. Now, we will go back here and we'll see that the number of Twitter's daily active users increased actually. That's a good sign, at least the company's active users do increase. And they also reported a loss of 270 million or 35 cents a share, which is terrible to see for a company like Twitter. Operating so many years and still posting losses, not a great thing to see. But compared with a year ago earnings of 65.7 million or 8 cents a share, this is, a little bit worse here. And yeah, you would not like to see that as a Twitter investor here. Now, Twitter said it was withdrawing earlier goals and outlooks and wouldn't provide forward-looking guidance in the previous quarter here. And that kind of does make sense based on what we're seeing right now. Things are looking a little bit dire for Twitter right now. Not looking great here. And of course, Snapchat has actually also played a role in this reception of the news, because it has been down about 25 to 30% pretty much today. We're still expecting the markets to open. They haven't opened as I'm making this video, so we're gonna see what's going to be happening later. But amid the expectations for the battle that's gonna be happening between Elon Musk and Twitter, we're getting a little bit of a decline here. Maybe investors are a little bit wary and kind of want to see how this will be playing out, because if the courts actually force Musk to buy Twitter, maybe the stock price will rocket again. So it's a little bit of a scenario that we don't know how it's going to be playing out. There's probably a couple of different ways this could play out. But for the most part, I'm assuming that Elon Musk will just pay some money to Twitter and then pretty much call off the whole thing. But we'll see. We'll see what the courts actually say about this. Have to say about this situation here. Now, you will see here that in regards to Musk, basically to Elon Musk, they have said, of course, and we know about it, that they have become concerned about Twitter's user numbers. They do expect a lot of potential bots happening in the company's active users really not being active, practically speaking. So they did want to clarify. They did want a clarification in terms of the bots from Twitter, and they don't seem to be getting that. And this is why, at least this is why, what they are claiming to be the reason for pretty much declining to go through the acquisition here. And remember that the bid for Twitter has helped the company actually propel its stock price and at least keep it at a higher level, because there was a sell-off in tech companies for a while. And even though Twitter has lost quite some in terms of its stock price, a lot of companies have been completely destroyed. As for example, Snapchat has lost way more than this and than that. And Twitter has lost about 50% while it's still not posting any profitable years really, and it's still in the negative for the most part at least. And so, having a picture of financials that are not looking great and still not falling down as much as some of the other companies, some of the rest of these companies that have fallen about like 80 or 90%. At least this has kind of helped Twitter. And the deal for Twitter values the company at $54 a share. You have to remember that, and Twitter is about 40 right now. If we go back, we will see, yeah, it's about 40, 39, 52. And we're kind of expecting again to see what's going to play out in, between the judges and basically the Elon Musk and the company. We'll see how that turns out. But for now, yeah, we're looking at the company being down a little bit. Now, obviously, the company is going to be trending right now. So if we take a look at the social trends, this is going to be much, much higher than yesterday, especially on StockTwits where things are discussed live. We're having quite some action happening right now. I'm expecting this to peak a little bit later as well as the markets open. But it's interesting to see what the company is going to be doing. We have talked about it in previous videos. This is a company that is very, very high in terms of in terms of its metrics, and it's actually losing money. You will kind of see here that in terms of the price to earnings ratio, they are having some better years and some worse years. Like for example, here you will see that if we take a look at the actual chart the graph actually that the tool gives us. Now the P ratio of the company, you see that being all over the place, but it has been negative for many years really, and that is super worrying and very high right now, and the price to free cash flow negative as well. So yeah, the whole financial picture of Twitter looks very suspicious here. You'll see the net income growth here pretty much going into negative territory. The same thing with free cash flow growth. That's a very, very bad picture for a company to see. And it's just a company that I just couldn't see myself entering anytime soon and actually buying any stock. Even if we take a look at our stock evaluation tool here, just real quick, we can kind of see that the revenue growth of the company on average has been 15%. So let's just say that I want to go with very high estimates here of 13, 15, and 17, and I actually follow this kind of revenue growth and actually accept it, even though it's very high for the next 5 years. Actually, I wanted to put 15 here. So the net income margin, you will see again all over the place, negative, positive, then negative again. You'll see that you just don't have a baseline here. The company doesn't really post steady net income here. Some years are positive, some years are negative. So what are you going to do with this margin? It's very, very tough to say. The average that you could use is like 8% if you actually include all the negative years as well. So let's just go with 10 here, 12 and 14, be a little bit positive. And the free cash flow margin, again, same story. Some years positive, some years negative. For the most part, they have been positive because they are adding back free cash, they're adding back cash-based compensation, things like depreciation, amortization. They eventually become positive here. But the rate that we will go with, again, it's kind of tough to deduce because of all these unsteady years. This is a type of company that I really, really dislike analyzing because it's tough. It's tough to find the baseline. It's almost impossible to understand what kind of price you need to be paying for this one. And so I'm going to be using 80, 90, and 100 and annual return of 13%. And of course, these projections are super aggressive too. I mean, they don't really make sense because, again, the company has been going up and down quite significantly, and this kind of revenue growth doesn't seem sustainable, really. So we're just trying it to see what kind of scenario we can have and what kind of thing it would play out if we actually accepted these kinds of projections here. And if we hit calculate, you will see here that we're not even close to the current price of the stock. And even if that goes down quite some, we are still going to be far from what we would want to see, even for this kind of estimates, which are, generally speaking, fairly confident here. Now, you could say that the net income margin could eventually, be at these levels, but this doesn't seem to be the case. Again, the company has been having minus 30% here, for example, or minus 4% here. It's, again, super all over the place, and you may actually counter and say that this is because of the pandemic, for example, that this has caused this kind of decline. But remember, 2017 was a similar year where the margins were also horrible here. So it is a business that is kind of tough to really evaluate because it's not steady in what they are doing financially, and it's a lot of risk actually entering right now. And I could even see myself going for a 15% annual return. And let's just say that I'm accepting a 30, 32, and 35% percent. Oh, sorry, I actually meant to do that for the net income margins. Let's just say that I'm doing 30, 32, and 34 is what I'm willing to accept, that very, very high margin compared to what the company has been doing. But I'm actually going to give a 15% annual return, because I'm accepting something that has much, much more risk of becoming a thing, really. It may never happen. And if I hit calculate with these values right now, you will see that it's only for these values with very, very aggressive estimates that our medium one becomes a marginal buy right now based on the current price. And this again would be a 15% revenue growth with a 32% net income margin and a 90% free cash flow margin, which it's very, very confident, frankly. And I could definitely see myself getting a better value at other companies. So if I'm to invest in a tech company, I could very, very easily, pick another one and have a much, much higher chance of success. So Twitter would not be for me right now. And yeah, I will see what's gonna be happening with Musk's Musk's lawsuit, pretty much. And I'm gonna be reporting as we get more news about it. Thanks for watching. Leave a like if you haven't done that already, and subscribe if you're not a subscriber too. And thank you for watching again. In the meantime, take a look at the video that I made earlier, and I'm discussing Meta, what's been going on with the company, which is also down today on Sympathy Play, on a Snapchat pretty much, Sympathy Play. And thank you for watching this one again. I'll see you soon, guys. Bye.